Technical analysis is awesome, but it's useless if you can't translate it into specific trades with a real world edge. In this video, our head of trader development takes technical analysis principles and gives you 5 proven trades with a bonus of the exact entries, stops, and exits. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional trader on our trading desk so you can grow your trading account.
Your ability as a trader to kind of use the technical analysis we're going to talk about in order to make good trading decisions, it's really imperative. It's important to understand the technical analysis components, but it's even more important to understand how to use those technical analysis components into making really good trading decisions. Technical analysis is just kind of the study of historical price movement, and it gives us a guide in as to what the market might do next based on what we've seen previously. You know, really, when it comes down to it, technical analysis is a driving factor in how we make the decisions about what price is going to do next. We take a look at what happened previously. A lot of technicians will talk about patterns, and we'll go into some of the patterns. But really what we're talking about is the price action. And it's so easy to get caught up in the emotions of the price movement because it can seem confusing, it can seem spontaneous, it can seem super inconsistent even at times. But every part of technical analysis and every part of our really good trading decisions oftentimes are generated because of this idea that we talk about called price discovery. So if you look at any candlestick, any chart, any individual candlestick, it's just a visual representation of price discovery over time. So a single candlestick it's just a point of information that details out where price is trying to go as measured by that one period of time. So a weekly candlestick is price discovery that occurred over that week. A daily candlestick, it's just a visual representation of price discovery that occurred over that day. Hourly, 15-minute, 1 minute. These are all just visual representations of price discovery that occurred over that period of time. They tell us the highest price discovered, the lowest price discovered, where that candle, that price opened, and where it closed over that individual period of time. You know, candlesticks are just super universal. They can be used in a bunch of different ways. And we'll even talk about how you can use them in kind of a unique way. Towards the end of this video, you can jump ahead if you want to, but really the best way to do it is go through this systematically. We even have cheat sheets that once you go through the video, you want to look through those cheat sheets. But in general, let's go back and talk about a single candlestick is just a piece of information. Nothing more than that on any time frame. A single candlestick is a piece of information. They're like a single piece to the puzzle. We take a single candlestick and we start to combine these bars, these candles. We take these individual pieces of price discovery of information, and then we understand the price action that's being told to us by those individual pieces. In a structured way, we're using technical analysis to put together the pieces of a puzzle. It allows us to categorically identify things that have happened, so then we can accurately determine what is likely to happen again. It's like having the picture of the puzzle we're actually building, the box, so that we can put together the pieces in a way that makes sense. We're still putting them together one piece at a time, but at least we can get a sense of how each piece of price discovery can come together to become that finished puzzle, that price action. We're going to go through that price action, but even more importantly, there's a step that most people leave out in technical analysis. Price action is not a trade. Price action is price action. Technical analysis is the study of price action. As traders, we want to look for trades. So we're going to go through this video. We're going to actually study the price action, the technical analysis of the price action. Most importantly, we're going to focus on the trades. We're going to look at 4 to 5 different trades in this video. All with edge, all very repeatable, all broken down through the technical analysis, the study of that price action. And then we're going to use that information, the combination of those information to identify our stops in the trade. where our entries would be in the trade and where our exit or multiple exits would be in the trade, depending on the information we've accurately identified by studying the price action. So let's get right into it. These same patterns, the same trades show up in futures, they show up in Forex, they show up in crypto, they show up in stocks, really any liquid and tradable market, they'll show up on any time frame because the technical analysis is the study of that price action for that time frame. So we're going to look at intraday data, but you will see the exact same pattern occur on a daily time frame, on an hourly time frame, on a 15-minute. But let's get into our first trade. So we've got this setup that occurs. So when we're looking at this price action, what do we see? We see a lot of indecision. We see an area where the sellers stepped in and an area where the buyers were stepping in. So we had a range developed. What we classify a range, it can go to the top of the range, it can come to the bottom of the range, but then we have a consolidation that occurs. And you can see the buyers tighten up and the sellers tighten up. We have a little bit of a what looks like a range consolidation breakout that occurs up here, but it doesn't clear the range. So now all we're thinking of is if this comes down and gets below the low of this consolidation, we can look for a trade to the downside. We're observing the price action and we're putting together the pieces based on one candle at a time. And we've got this sped up like 10x. So in general, this is going to move pretty quick, but we're going to talk about the specifics of the trade. So our number one trade, the first consolidation break trade that we could look for would be a consolidation breakout, either above the high of this level or below the low of this level, kind of outside of our blue lines. If we're taking a straightforward consolidation breakout trade, we're paying attention to the price action. We're seeing the selling pressure build up. We can enter if there is a full close below that range. If that occurs, then our stop, based on the price action, based on the technical analysis, would be up above the highs of the range. So we can get in right here on that candle, and our stop is above the highs of the range. We would risk accordingly. There's another option though, and that other option would be to trade a break and retest. We call it a second chance scalp. So that would be price action that breaks the range, but we notice how choppy that range is. When the range is that choppy, we oftentimes will get a retest of that range, of the backside of the range. And then we want to take the continuation trade. So what we're looking for specifically is the price action to test into that. We want to see it put in a distinct high on the retest, right? And then we're looking for continuation to the downside. So let's watch the tape as we get in here and watch the price action unfold and see if we can see a distinct, clear failure on the test. Okay, we have that. So now our stop can go right above the highs of that candle. And we can look for the first close away, which we have right here. And we can take that trade to the downside. Now, the rules are that our initial exit would be right here at the low of the range. But the reality is, let's look at what happened. We had this entire range that set up. We can think of it as a range break trade or a consolidation breakout trade. And we can look for 2 times the height of that range as our exit. So we're getting like insane risk to reward if we're taking that second chance with our stop right here and our entry right here. We're still getting really good risk to reward if we enter the trade here with our stop up here because we're still looking for 2 to 1. These are different trades, but they're both really valid trades, and it truly depends on how aggressive you want to be with your trading. We're seeing this continuation, and this is giving us a guide as far as where we should be taking our exits. Again, we're thinking about this range, right? Whoa, there we go. So that's where we'll take our exit. We had a really distinct move that went 2 times the height of the range that was there. That is a really good, straightforward 2 to 1 range trade. When you get a breakout of a range, the most simple way to do it is look for a 2 to 1. Let's talk about the next trade because we're already setting up the next trade. The next technical analysis component that we're going to talk about is extension. So we just covered what ranges are. Now we're going to define extensions. Extensions and overextensions are just a measure of the distance traveled over the time. So this is a minute chart. So we're looking at how quickly did this distance travel in the time that it took. We were consolidating for a pretty significant period of time. And this entire distance, twice the distance of the height, was traveled 20% of the entire time of that consolidation. That's a pretty fast, sustained move. Because of that, we can look for maybe a failure and some sort of retracement. We actually get this as it's setting up right there. Did you notice how we tried to break down and we put in what's called a double bottom? That's actually a bottoming pattern. And when we have that extension combined with a pattern, we have a low put in, we have a move up, we have another low put in, and then when we break what's called the neckline right here, we can enter our trade long. Our stop would be below the entire low of the move, right there. And we're targeting at least a 1-to-1. This isn't a super high probability trade. This is a very straightforward fade trade though. So when we get our 1-to-1 target right up into here, which happens to be another thing where we're running into, okay, we take our exit. That's it. That's the whole trade. We combine the extension component with a price action component. We wait for the neckline to get broken. We take our trade and we look for a 1-to-1. So we're skipping forward and we're looking at what's occurring again. And we've seen the same setup occur where it's this range that's forming. And we've got a range that's conformed by the horizontal trend line on the top and the horizontal trend line on the bottom. We're seeing buyers step in every time it comes down to the lows and sellers step in every time it tests the highs of the range. People will say, oh, look, there's a triangle, and I guess that is true. We could look for the break of that, and if you take that trade, you have a really nice, again, break and retest of that, and then we would look for a move up here. Your stop would go below the low of the triangle, and you would be targeting price action coming right up here. The challenge with this trade is, and it is a tricky one, it's because it's in the middle of congestion. It's in the middle of all of this range. We call this stuck in range or midpoint. This is basically midpoint. So could it work? Yeah, but is it a high probability trade? No. If you took this exact same setup, this exact same price action right here, and you put this at the high of the day or the low of the day, it would be a much higher probability trade. But when it's stuck in all of this nonsense, all the up and down, it's stuck in the middle of this entire range, you have a super tricky trade. And think about it from the perspective of the participants involved. You have traders on both sides here who were in from the lows or in from the highs, and they're going to cause all this havoc in the price action. So it becomes really, really difficult to actually look for a clean move. This is one of the key principles of any technical analysis is you want to avoid mid-range trading. And the reason why you want to avoid mid-range trading is simply because mid-range patterns are more prone to failure. Patterns are, and technical analysis in general, is best used at the extremes. So it's used when there's been a very clear reset and a very clear extreme that's built out on either the highs or the lows, or a very clear overtime pattern. Those tend to be the best. When it's mid-range and it's choppy like this, it's really, really difficult to get an accurate read, and you can be fodder for, unfortunately, the market makers that are going to push it in both directions, stop people out of their position, and then rebid. There's the old expression, if it doesn't scare you out, it's going to wear you out. And a lot of times being mid-range is going to be a big problem in that. So you can look at the trade and you can say, oh, it stopped me out at the lows and now it went to the highs. The reality is it's probably something to avoid entirely. But let's see what happens when we come up into this resistance area, right? We have this clearly defined resistance area. And again, we have our clearly defined support area. We're talking about a range here. It looks like we're going to break out of that, right? So are we going to take that range break trade? Well, let's look at the difference from this, the price action moving up in this side versus the way the price action moved on the prior range break. When we're looking at technical analysis, you could say, yes, these are both range break trades. But when we study the price action and the way the range broke, when we study the price action and we look at the strength that led into that, we recognize that this range, either it's going to work really well or it's going to fail. And the reality is this is more prone to fail when it's come a long way into it. Think about the energy that it's used to get to that point. From the low of the range to the high of the range very, very quickly. When we look at what happened previously, it was very methodical. It was like that momentum, that supply was kind of building and building and building. And then finally, when the range broke, it really broke. This was almost chasing. So it went right up to the highs of the range. So that's something that you always need to be aware of. It is more prone to failure when it goes a long distance fast. You actually want to see what's called a running break, which that running break is usually 3 or 4 candles that just kind of 1, 2, 3, 4, and then break. You don't want to see a sprinting break. Sprinting breaks are usually really, really tricky, and they're prone to more failure. As the price action fails, you could actually take a failed breakout trade here. That's a part of the reason why you want to respect the price action as it's coming in. The failed breakout trade would be once you get a close below that range, you would be stop above the high of that range. Why? Because the stop would tell us it is placed based on where the sellers wouldn't let it get higher. Our entry would be as soon as the bar breaks the low of this little tiny range, right? This range is built out. We would be looking for it to fail and then go to the other side of the range at least. And we see how fast it went up and we see how fast it comes down. That's a failed breakout trade or a failed range break trade. You want to be as close on entry as you possibly can be. You want your stop to be just above the highs, and you always want to target the other side of the range. All right, so we jumped ahead just a little tiny bit, but let's look at what the price action's telling us. Each individual bar is showing some indecision, right? We have a red bar and then a green bar and then a couple red bars and then a green bar and then a red bar and then a green bar. What is the price action telling us? It's telling us that sellers are pushing, right? Because we have a downtrend. We have clearly lower highs and lower lows made almost each bar. But we're also seeing that buyers are stepping in. This is something to take note of, especially when you're seeing something like this. I press down into the lows of the range. Because the question we're asking ourselves is, how sustainable is this? And one of two things can happen. The sellers can take absolute control, which is a viable option. What would we look for? We'd probably look for like a second chance break, or we would look for maybe a little consolidation that goes sideways. So we would see the pattern change, maybe a little pop and see, before we break, see that buyers try and take control, something like this, and then look for it to actually roll over. We would use a stop above the high of wherever that pop comes from. But we don't want to get into the predictive nature. We want to get into a game where we're waiting to see what happens. We're thinking about what could happen, and then we're putting ourselves in a position to allow that to happen. That's one of the key things of technical analysis. It's listen to the price action in order to understand what is happening so you can adjust your trading to what you want to see happen, to basically what is going to happen for you. So right now we have something that we call chop or hot garbage, right? The price action's holding near the lows, but is it trading like sellers are in absolute control? No, not at all. It's just super choppy. We don't know which direction this is going to go. We don't need to predict what direction this is going to go. We don't need to pull out our book and say, what pattern is this? because the action isn't showing that there's any real information to be had here. It's like when we went back to our mid-range trade previously. This is just chop. Wait for a change and look for something that's clear. All of our price action patterns, all of our technical analysis work better when there is clear participation. They tend to and are prone to failure for continuation when the price action is really choppy. And a very simple way to look at how choppy the price action is look at the size of the wicks relative to the size of the bodies of the bar. Because we had that forced breakdown that we just saw, we can now think to ourselves, if we get continuation lower, what would we look for? Well, we would want the price action to be clean. If we get a move back higher, what would we look for? Well, we would want it to get above some sort of level, right? We would want something like prior resistance, like, so let's say this area right here where we saw the sellers not really give any room to the buyers, right? We saw the buyers try and step in. We would want that area to act as support. So a key tenet could be prior resistance becomes support. The reality is, could you have taken this trade and made money? Absolutely. Would it have been difficult? 100%. There are traders who will take this trade and they will do very well with it. They'll say, oh, I shorted that and look, I was rewarded. But based on the price action, it's telling us that this pattern is somewhat prone to failure. This pattern isn't really supported by the real participants that we like to see. When we look at each individual bar, we put those together to get the price action. We can think to ourselves, well, what's really happening? This feels forced. This doesn't feel right. Are we really sure that we're going to get the continuation we want to see? And then we monitor to see if there's something distinctly different. And what we're seeing right now seems to be a little different. Do we notice how quickly that changed off the lows? Now we can use this little area right here to monitor for the potential of something that's different. We see it holds. Okay, it's trying to go higher. That's very, very interesting. Okay, now we can think about, do we have a failed breakdown? We talked about the failed breakout on the other side, but do we have a failed breakdown? We need to combine it with a price action pattern. So we still don't have a price action pattern, but we're going to get into one right here. So we moved right up into that area of prior support. The way that it traded lower and then came in here makes us think, look at the distinctness of this selling. Well, if we break this to the upside, we have something that's called an ABC scalp. A on that first leg, B on that very clear, distinct selling pressure right at that key level. And then if we break this to the upside, now we can look for a C leg. That is a trade that we can make. Our stop goes simply right below here. And instinctually, we're thinking that this can grind higher. We're going to use the 9 EMA as our trailing stop. That's this light blue line that we have right there. And you'll notice it's been on our chart the entire time. The 9 EMA is just a moving average, an exponential moving average. That exponential moving average gives us a lot of information about which direction, who's really in control. In momentum type trades, price will hold that 9 EMA. In extreme momentum, price will pull away from that 9 EMA. All we're doing in this little ABC scalp we took right here, stop right there, is we're looking to see, does the price action start to continue to show momentum to the upside? Why are we doing that? Because we observed the type of selling that was occurring as the price action was coming lower. It's a little tiny thing, but these little things become so important. Now we're back up above this entire area, and we have that really strong extension. We're still trailing with that 9 EMA. We can trail our stop, trail our stop, trail our stop with that 9 EMA. We allow the price action to do what it's going to do. Now, the reason why this trade would work so well is because of the weakness of this breakdown. We talked about it the entire time. This doesn't seem right. This doesn't feel right. It doesn't look right. This is the response from that. We had this really distinct price action pattern that we could trade. When we didn't need to trade off the lows, we could wait for that to come in, and now we can trail our stop all the way up, still using that 9 EMA. At this point, we're almost to VWAP, the purple line, which tells us that that's a balance point on the day. VWAP, the volume weighted average price, is always typically a balance point. That's why a lot of traders will have VWAP and the 9 EMA on the chart, because they're seeing what side of the momentum we're trading on, but then also we're looking at what side of balance are we on? Are the sellers generally on the day in more control than the buyers? When you get that hard move up to VWAP, well, that's a really, really good, very clear, distinct move. We still haven't had to exit our position because we haven't had a close below the 9 EMA. When we have all of this occurring right at this area that was prior resistance, we're likely going to get stopped out here, and that's perfectly fine. That convergence concept that's become so important, where you have a 9 EMA going up into that level and VWAP right there, that becomes so important. But let's look at where the price action's pulling back to. So we took our stop, and it pulled right back into this level of prior resistance. Does this become support? Once we get a close back up, we could take a long trade with our stop below the low of the wick. Right there, we could take a long trade with our stop below the low of the wick. Again, going back to our second chance scalp. And we're targeting, in this case, the natural target, which is the high of that range. We sit in the price action, and then we exit the trade just like that. So what have we really covered here? I understand this isn't a normal technical analysis video. You're not looking here and saying, oh, Jeff, you didn't teach us about patterns. You didn't teach us about this and that. What we talked about was the absolute psychology involved in the price action as it evolves. If you want to know patterns, we talked about a cheat sheet, technical analysis patterns that traders will use on the desk. They have rules around them. We didn't include the trades because the reality is you need to have a trade even when you have a pattern. A pattern in itself on our desk is not a trade. It's just a pattern. You still need a defined stop, and you need a defined entry criteria, and you need a defined target. And I understand that a lot of technical analysis does include those elements. But as we saw in this video, when you look at the actual price action, that's telling a story that the technical analysis sort of tends to skip over. And so you want to be thinking about not just what is the pattern that is unfolding, but how is that pattern unfolding? What are those individual pieces of information telling us? And how do we put those together in order to identify appropriate price action for us? When we can put those together, we're identifying what is happening, but then also what's potentially likely to happen next. And that can just put different trades on our radar. And once we have different trades on our radar based on our listening and our understanding of what is happening, we can put ourselves in those really high probability moments over and over and over again as traders.